Everyone, I just found a stock that is seriously undervalued by the market. Its intrinsic value is high. This is a golden investment opportunity.
Here we go again. How do you plan to calculate its intrinsic value?
Simple. Based on discounted cash flow, DCF, this company's future earnings growth rate is 15%, its dividend payout is stable, the risk level is low, and market interest rates are in its favor.
So your theory is, if the intrinsic value is higher than the market price, you should buy it and sell it when the price returns to a reasonable level?
That's right. This is the golden rule of investing.
Kid, I've heard these grand claims too many times. Are you sure this company isn't exaggerating its earnings?
Probably not.
This is one of the problems with fundamental analysis. How do you know the company's reported data is real? Remember Enron. Their reports looked perfectly healthy, but the CEO kept two sets of books, one for investors, one for himself.
Alright, but what if the data is real? I can calculate a reasonable price based on earnings growth and market interest rates.
The problem is, your calculations rely on assumptions. Are you sure future earnings growth won't change? How many companies had 15% growth before the 2008 financial crisis and went bankrupt the next year? Also, let's say you analyzed a stock perfectly and estimated its intrinsic value correctly. But the next day, the CEO has a heart attack, and the stock price crashes. Do you still think fundamental analysis is useful?
So, you're saying fundamental analysis doesn't guarantee beating the market?
Exactly, but the market is too complex. The information might be inaccurate, analysis can be flawed, and unexpected black swan events happen. Retail investors shouldn't expect to win long-term with this. Kid, the market is smarter than you. Your calculations won't make you the next investment guru.
Everyone, look at this 200-day moving average. This is a perfect golden cross pattern, indicating the stock price will continue to rise. Wow. Does this really work?
Please, these people trade by drawing lines on charts, just like ancient astrologers predicting the fate of nations by looking at the stars.
Then why do these patterns sometimes work?
Because everyone believes in it. If enough people think the golden cross means a buying opportunity, they will all buy, and the price will naturally rise. But once everyone knows about this trick, it stops working.
Technical analysis has several problems. First, when prices reverse sharply, technical indicators can't react in time.
Second, market information is asymmetric. Insiders already know major good news, while retail investors relying on technical indicators are just picking up scraps.
So, technical analysis can't help me beat the market either.
Kid, the market isn't as simple as you think. There's no holy grail strategy here. The only way to win is to avoid losing too fast.
No way. Yesterday, this stock was up 10%. How did it drop 20% today? This must be the market's fault.
Kid, you've fallen into a psychological trap.
What trap?
Your reaction just now perfectly demonstrated for common psychological traps, and you fell for all of them.
This stock can't drop. I analyzed its fundamentals, technical trends, and even got insider tips. This time, I'm sure to win.
This is overconfidence. You think you're smarter than the market, but in reality, the market doesn't care about your calculations.
So, I'm not even a match for the market. This stock has bounced off this support line 5 times before. It won't be different this time.
This is cognitive bias. You assume past price patterns can predict the future. But the market doesn't follow your script.
This stock is about to take off. Don't miss out.
This is herd mentality. When the market is booming, everyone fears missing out. But when the bubble bursts, everyone rushes to the exits at the same time.
Should I sell?
This is loss aversion. People hate losses more than they desire gains.
So, the market isn't the problem. I am my biggest enemy.
That's right. The market is random. The only thing you can control is your own behavior.
Why do I always lose to the market? Aren't professional investors supposed to be better?
This is the biggest myth among retail investors. In reality, studies show that long-term investing in index funds outperforms actively managed funds.
Hi, have you been here long? I just heard you say long-term investing in index funds is better than actively managed funds. Do you have proof?
Of course. For example, if you invested $10,000 in the S&P 500 index fund in 1969, by 2014, it would have grown to $736,000. But if you had put the same amount into an actively managed fund, it would have only grown to $501,000.
So that means, investing in index funds is really better.
That's a huge difference, right? To beat Wall Street, you need a solid investment strategy.
Alright. Where should I start?
Let's talk about how to design a reasonable portfolio. First, risk and reward are proportional. The higher the risk, the higher the potential return. But how much risk can you tolerate?
If I want higher returns, should I invest in higher risk assets?
That's right, but you can't decide based on expected returns alone. You also need to consider your risk tolerance.
I heard the stock market is risky. Is it really suitable for long-term investing?
Historical data shows that over a 15-year holding period, the stock market has never had a negative return.
Then if I buy and never sell, does that mean I'll always profit?
Not exactly. You still need proper asset allocation and periodic adjustments.
The market is so volatile. How do I avoid buying at the peak?
Dollar cost averaging DCA means investing a fixed amount every month, regardless of market fluctuations.
So this way, I won't be dumping a large sum into the market at its peak, right?
Exactly.
I'm young, so I should be able to handle higher risk, right?
That's true. But if market volatility makes you too anxious, excessive risk could lead you to make poor decisions. Check your investment portfolio periodically to ensure your risk allocation still aligns with your goals.
If an asset's value skyrockets, should I sell some of it?
Exactly. This helps lower risk and ensures your portfolio remains balanced.
So, professional investors can't consistently beat the market?
That's right. The market is random. The best investment strategy is to hold low-cost index funds for the long term and optimize returns through asset allocation and risk management.
This time, I finally learned the right way to invest.